Good evening, everyone. Buenos Aires. I am Jeremy Leonard from London. I'm the Director of Industry Services for Oxford Economics. And some of you may know we produce an annual global pump report. And so I'll be talking a little bit about some of the results from the forecast that we did 9 months ago, but I think more importantly about what's happened to the industrial economy since that time. And so I wanted to start, so I'm going to do this in 2 parts. I'm going to talk a little bit about the global industry overview to give you a sense of how things are looking across the world. Then we'll look specifically at some of the pump markets that are of more concern to the distributors in this room to connect the dots with what's happening in the world to the markets that are important to you. I'm really pleased to be able to say that there's actually quite a lot of good news in the global industrial economy, which has not been the case for quite a number of years. We think that the global economy is in the strongest position it's been in several years. And the good news is that the forces that are there are very strong for the pump market and very strong for Europe in particular, 2 very unusual things. The main reason that we're optimistic is that we have seen finally the 3 key elements for a pretty strong investment rebound. So I'm going to focus here on the bottom chart here, which is showing you manufacturing spare capacity in the developed world. And you can see that for most of the post-financial crisis, that level of spare capacity was a lot higher than it had been in the past. So obviously when there's a lot of spare capacity, there's not really much appetite to invest. We combine that with the Eurozone sovereign debt crisis in here, the financial crisis itself, which severely restricted access to credit. I'm sure people in this room felt the full brunt of very weak investment. We see some interesting things happening here. Is that if we consider, and keep in mind this is looking at the US, Europe, and Japan broadly across the developed world. We're finally seeing that industrial spare capacity is essentially back to where it was prior to the financial crisis. That means that companies are ready to invest, they have a need for investing, and also they have access to funds. If we look at cash flow, if we look at cash on hand, we heard just about in the tech sector, but across a lot of sectors, there's actually companies do have a lot of cash. And the final thing is that we're seeing a very strong uplift in broader economic demand and global growth, so they see the appetite to invest. Confidence is improving. And with those 3 sort of essential conditions for investment, we've started to see investment take off here in Europe. Investment's very strong in the US, and we think these are going to persist, and that's why I think the backdrop for pump demand in particular and industrial activity more generally is very, very strong. And again, I just want to sort of highlight here, for the first time in a long time, Europe is actually leading the industrial recovery in the developed world. You can tell from my accent, I'm from the other side of the pond, and usually the story is, well, the US is doing great, and they're bringing Europe along with them, kicking and screaming, but that's not the case at all right now. In fact, we've got Germany is probably going to grow at more than 3%. I'm talking now industry. Italy as well is going to grow 3% this year, France as well. And so we're in an unusual situation where the forces that have driven industrial demand across the world are actually originating in Europe. In fact, we're actually seeing European supply chains rejuvenate. So intra-EU trade is picking up. So countries in Eastern Europe as well, even some of the smaller countries in the Eurozone that had been having problems like Greece, Portugal, et cetera, really seeing a sustained uptick. Now, the other thing to mention is that in the US, we do have quite a lot happening. We have the corporate tax cuts that have been implemented in December, which are going to provide a big boost to broader investment in the US. Those of you who are following oil markets, obviously we know that the US oil markets are doing very well, but that's spreading across broader to manufacturing. I'm not going to talk too much about tariffs because they mainly affect the steel sector, but obviously if you have questions about it, I'd be happy to talk about it. But we don't see that as a big break on what's happening in the US, and we see the US having a very strong year next year. So this is just our summary outlook for industrial production. You can see the main narratives here. Last year was a very strong year globally, certainly when we compare to 2016, and indeed most years since the financial crisis. But if we look at 2018, actually we look at a little bit of an acceleration. So the factors, this investment rebound I was talking about, this uptick in global trade, are going to work to offset the kind of secular slowdown that we've seen in China. So if we just look down here at some of these numbers, look at last year, Eurozone led the charge in the developed world in terms of industrial activity. We think the US is going to pick up quite a lot this year due to the tax cuts. and the broader recovery in the oil sector. But looking down this list, even in the UK, where we've got Brexit worries, the UK is benefiting from the uplift in activity in continental Europe, as well as benefiting from weak sterling relative to the euro. And I think the only other thing, I mean, China is certainly the people in this room, I think it's of lesser importance, but I think this is all happening in the context of a secular industrial growth slowdown in China that we're all familiar with. But quite interestingly, when we look at this year and even really into 2019, the momentum in the developed world is going to be enough to keep that global rate at a pretty high level, and indeed higher than overall GDP. So we do see this as a kind of cyclical upswing in industrial activity. So I think all that's important just to bear in mind as we look at the global pump market. And I'm not going to spend too much time talking about this, but just to remind you that we do produce an annual report that's distributed to EUROPUMP and S.R.L, two member organizations. It's backed by the full power of our modeling infrastructure, our 200+ economists. I have a team of 12 sector experts, and we have macroeconomists covering over 200 countries. It's provided to you as a written analytic report that essentially goes into a lot more detail of the kind of points I'm making right here. And it also has an interactive Excel spreadsheet where you can look at the data across about 15 end-use sectors, 5 different pump types, and look at about 75 geographies. So it's a very powerful tool for understanding your particular market that you're looking after. And again, I just repeat that I'm going to show you some forecasts that date from 9 months ago. We are in the process of updating them, and the new report will be ready for the EUROPUMP meeting coming this May. So I think just globally, I think it's important to see that Asia Pacific is the biggest part of the global market. I'm not going to compare that number to the market cap of any of the tech companies that we just heard about because it's not very flattering, but nonetheless, a $60 billion global market. I'm going to focus mainly on this piece here because I think most of the people in this room are distributing in Europe, Middle East, Africa, and Latin America. But I think it is important that each region is important in its own right, and it's certainly not the situation that Asia Pacific is actually driving growth looking ahead, precisely because of the China slowdown that I was talking about. So just a sort of broad global perspective on markets, you can see from this chart that actually, and by the way, this chart actually includes hydraulic pumps and parts and a few other things, so the market number is bigger than the chart before. But the point being is that we've had several years, as I alluded to earlier, where the pump market's actually declined very slightly, albeit from a pretty high level. And we can see in 2017, we saw a 4% increase in the market, which was probably a little bit weaker than perhaps what we saw in terms of the industrial outturn. But what's quite significant is the overall global market is still quite high relative to the financial crisis. And what's happened here is that very strong growth in Asia has kind of offset the impact of the financial crisis, which is very concentrated in the developed world. So you see that globally, the market is in quite a good position. Now, when we looked at this forecast 9 months ago, we thought that the rates, about 4% market growth, seemed a reasonable global growth rate. I personally think that number is going to be a little bit higher, given the improvement we've seen in the global context, and more importantly, I think in some of the markets that are of concern in this room, particularly in Europe, we're likely to see a much stronger outlook than what we're going to see here. So I just wanted to talk a little bit about the sort of end-use sectors and looking at some of the sectors that I know are important to Sealand. And we're looking now here at the sort of longer-term outlook, so the 4-year average growth outlook in the Europe, Middle East, Africa, and LATAM markets. And you can see a couple of interesting things. The first thing is that Europe is very, very strong. If we think of European as a developed market, that's a fairly mature market, these growth rates might surprise a little bit. So looking at general industry, construction, looking at 5 to 6%, these are average annual growth rates for the next 4 years. You may ask, well, what's going on here? And the answer is that there's a lot of catch-up investment that needs to be done in Europe relative to where we were at the depths of the sovereign debt crisis. Because if you look at rates of investment, investment intensity in pump-using sector, it's been very, very weak. And so what we're likely to see is a catch-up, essentially. It's not going to be necessarily expanding new capacity, but it's going to be the fact that investment has been postponed for so long that we're going to see quite a sustained period of above average growth. And you can see here that if we compare Europe even with Middle East Africa, which I'll come back to later as as one of the future growth markets in terms of thinking about pumps. If we look at some of the key sectors, actually Europe is doing quite well. I should just mention construction as well, where we've seen not only the resumption of building after the housing busts in places like Spain and France, but also the influx of migrants into places like Germany. We've seen huge increases in residential construction. Again, the pumps and the water associated with that comes hand in hand with that kind of investment. Now, the one sort of not so good story is what's happening in Latin America. You can see our outlook is fairly pessimistic. And this really comes down to the fact that Brazil and Argentina, two of the biggest markets, have not done well. Brazil in particular has not been doing well recently. It's starting to turn around. But Argentina in particular, the policy environment and other factors mean that the industrial outlook is actually quite weak. So it's going to be a tough market, we think, in Latin America, looking ahead across the end-use markets important to Sealand. And our report actually looks at different kinds of pumps. And so I know that for Sealand, centrifugal pumps are of particular importance. And so what I've shown here is now just looking at Europe and looking at how that particular segment is likely to perform relative to the broader other types of pumps. And I've shown it just for the big Eurozone majors and then aggregated the rest of Europe. And the encouraging thing here is that centrifugal pumps are generally expected to outperform other pump types. And I think it does come down to the particular end-use markets that are expected to do well. So if we think about centrifugal, the water pumps, the water applications, and we think about their applications in industry and construction, et cetera, these are the very sectors in Europe that are set to do quite well. So this is in some sense not surprising given our views on the end-use sectors. But again, what's important here is that you see that it's not just a German story. It used to be that Germany was strong because the areas outside of Europe were strong and Germany has much more trade exposure there. That's no longer the case. And I think the fact that France and Italy, even the UK, are expected to do about as well, I think that's a testament to the broader strength in Europe, the fact that European supply chains are gearing up. What's quite interesting is that the rest of Europe, and here this does now include Eastern Europe, is actually set to lag the Eurozone majors, which is a bit surprising in some sense. Eastern Europe manufacturing is doing quite well, but the parts of manufacturing that are doing well are really automotive. There's been a lot of migration of automotive production into Eastern Europe and a lot of support from the European Commission investment funds, particularly in Poland. And we expect that the effects of those are going to weaken over time. So, I mean, obviously you have to put this into context. You also have to realize that our definition of Europe also includes Russia, on which we're quite a bit more pessimistic. But again, the point being is that you see a pretty broad-based growth across Europe, and you have markets that are important to Sealand in terms of the centrifugal segment, generally doing better than other types of pumps. I wanted to finish by talking a little bit about the Middle East and Africa, because we at Oxford Economics see this as the kind of, if we think about the next frontier of growth markets. And the story here is really about diversification away from oil, because at the moment, countries like the UAE and Saudi are having challenging times in terms of pump markets. And again, we're looking at centrifugal pump markets here in Middle East and Africa. And you can see here what's happening here, this difference, if we compare that to Israel as a different example, as a non-oil producer in the region, is that we're having the impact of low oil prices on public finances, because most countries in the Middle East now operate on an economic model where the government is responsible for a lot of investment, and that revenue comes from mainly oil revenues. And we can see the struggle here, but we do see that as we get out to 2021, we see those growth rates increasing because it's our view that the efforts by the governments, particularly in Saudi, but to a lesser extent in UAE, to diversify the economy, to use government resources to develop not only things like tourism and service sectors, but also to develop a manufacturing base that is largely coming out of petrochemicals, but expanding that into different kinds of sectors, is something that ultimately we think there's going to be some success at. It's going to take time, and with oil prices where they are, and the revenue situation the way that is, it will take time. But I think when we look out to 2021, looking sort of over the horizon, we do see the Middle East as quite a robust market in terms of pump demand. I'd be interested to hear feedback from you, because if we think about ideas, we're thinking about, well, what are the next growth markets? I think if we come back to what's strong right now, I don't think we can say that Europe is at some kind of renaissance in the sense that we're going to see Europe outperform the rest of the world into the foreseeable future. I think we have a window of opportunity here for the next 2 years where market conditions are going to be very favorable. I think that's going to give it the opportunity to a company like Sealand to be able to use those resources to think about where to invest for the future. So with that, I'll stop. I realize I may have gone over time, but I'll be happy to answer questions later on in the panel discussion. Thank you very much.